when you've got growth slowing, which we think is the case for the remainder of the year, that's not a great environment for cyclical industries or small caps. So it seemed like a quick reversion, but we don't necessarily think that now's the time to really jump into small caps and cyclicals, thinking that there's going to be this catch-up trade. We think it's more likely that the tech industry, the semiconductors, the AI names are going to pull back more to the rest of the pack rather than everything else is going to catch up and go higher.
Chance Finucane returns to the show. He is a CIO of Oxbow Advisors. We'll be going over his latest market outlook and how he plans to factor in the latest valuations from the stock markets into his decision-making process. Welcome back to the show, Chance.
Great to see you, David. Thanks for having me back on the show.
Stock markets continue to grind higher. Valuations are at an all-time high. We'll talk about that. We'll talk about what's leading this charge upwards. But first, let's address the unfortunate assassination attempt of Donald Trump over this weekend. We're speaking today on Monday, July 15th. The Dow is up about 250 points this morning. The S&P is once again at a new all-time high. The markets, from what I've read, are factoring in I guess, a higher chance of a Trump victory following the events over the weekend. I'm not sure if you've been looking at this news and factoring in politics at all into your analysis and your decision-making process.
We pay attention to it. So a website like Predict It, you can see the movement and what's expected. And it does seem like Trump's odds of winning the presidential election in November have increased somewhat. But in terms of how we manage the portfolios, I remember having a lot of conversations like this with clients 4 years ago during the last presidential election year. And the answer is we really don't maneuver or overhaul our portfolios based off an outlook of who's going to win the next presidential election. Our favorite line is Warren Buffett saying that over the course of his illustrious career, half the time the person in office was the person that he did not vote for, and yet it didn't affect how he invested and the results he was able to generate. So while we pay attention to what's happening in politics, we don't let it dictate how we decide to orient the portfolio. So the way that we're currently set up is likely how we're going to stay set up for the remainder of the year, regardless of what happens in the election.
Well, do you think that a Trump victory over a Biden victory would see 10-year yields jump higher?
It's possible. I've seen that a potential increase in fiscal spending or sustaining that fiscal spending track that we've been on. We're going to have an increased supply of treasuries being put out. And then if there is any additional tax cuts, that could lead to a greater deficit. And all of that may point to bond investors wanting a higher yield. So that's possible. But there are so many moving pieces in trying to forecast where bond yields are going to go. I think that maybe is a little bit too narrow of a view to just say that because this person is going to win the election, therefore yields are going higher.
Would a return to Trump tax cuts also be more favorable to equities, hence impacting your decision?
It could, but if people remember, the drop in taxes in 2017, that was a 35% corporate tax rate cut to 21. That was a huge drop, and that was a significant driver because you had 14% more earnings going to the shareholders rather than what you had before. Any sort of sustaining of the tax cuts or a little bit drop further is going to be much smaller compared to what we had 7 years ago. So I don't think it's as impactful if there was something like that on the horizon.
The Warren Buffett indicator has been making rounds in the headlines. It broadly indicates a valuation using the metric of market cap versus GDP. It's now higher than the dot-com bubble. It's higher than the great financial crisis. It's just at an all-time high. How are you interpreting this data, Chance?
Based off your tone, I'd say we're on the same wavelength that when it's that high, it probably means that valuations in the marketplace have gotten a little bit too extreme. Really, with something like that, you're looking at profit margins at record highs. And some of that is due to the quality of companies around today that are driving a lot of the profits are just higher quality businesses than what we had 20 or 30 or 40 years ago. So it can be a somewhat higher ratio than what we had in the past on average, but to see a record level matches our thinking that things have gotten too far ahead of themselves and would not surprise us at all that there is an inevitable bear market or correction on the horizon just to get back to a more reasonable valuation level, whether you're looking at the Buffett indicator, free cash flow yields, price earnings ratio. There's a lot of different ways you can slice the data, and it all suggests that we're probably in the top 10% valuation over a 40-year history, and that just doesn't sustain itself for too long before you get a pullback.
Before we continue with the video, I want to tell you about another way that we can protect our wealth. Now, even with inflation coming down a bit, the Fed funds rate still hasn't come down and is looking to stay that way for the summer, at least. This highlights the need for more diversification. A 2022 report from Citi details an asset class that actually has a negative correlation to stocks. Forbes also notes that this asset class can protect your portfolio from inflation. Citi and Forbes are actually referring to blue chip contemporary art, which may sound like an obscure asset class until you consider that billionaires sit on nine figures plus in art collections. Billionaires like Microsoft co founder Paul Allen. That's why you should check out today's sponsor, Masterworks. Their art investing platform has distributed over $60 million in investor proceeds across 23 exits. You don't need to be an art expert or invest millions. Masterworks offers blue chip paintings as shares. Previous offerings include artists like Picasso, Basquiat, and Banksy, and they're nearing $1 billion in invested capital. Scan the QR code here or click on my link down in the description below for priority access. Does it make sense to you? I'm just theorizing here that perhaps more of the S&P 500's earnings are coming from overseas, meaning foreign buyers of American companies' products. And so maybe domestic GDP may not be a very useful denominator in this metric.
That's part of it. I've made that argument in the past related to this metric to colleagues at other firms that you've got, let's say, 40% of the S&P 500 cash flows coming from overseas. And maybe that was a smaller number decades ago. But I think that component from international has been pretty similar over the last 25 years. So I don't think that it's a totally new metric to use if you're looking at like a 30-year history of that ratio. So I think when you get to this extreme of a level, maybe it's not as crazy, even though it's a higher number than what you had at the dot-com bubble peak. It may not be as crazy because there's more coming from overseas, there's higher profit margins, but it's still a pretty extreme measure that suggests that there's a correction coming at some point.
You have here on one of your slides, AI stock valuations are sky high rather, and then you have here something called the Artificial Intelligence Index, which is has just moved up in a straight line. First of all, what is this index, Chance?
That's an index of 9 companies that Investec Research pulled. I'd imagine it includes names like NVIDIA, Microsoft, Supermicro Computer, names that have been real beneficiaries of this AI trend in the last 2 years, just to try and get a basket of stocks that best represent what's happening and seeing how much they've moved. So there was a 50% decline in these names in 2022, but since then they've skyrocketed higher. And what we're looking at is just the valuation, whether you're looking at the price to sales multiples, for example, are multiples higher than the NASDAQ or the S&P 500. And even though there's a lot of earnings growth projected and maybe a lot of great growth ahead for these businesses, that appears to be already baked into the current share prices. And when we look at identifying what the fair value is or what our estimate of a fair value is for a lot of these companies, the current share price is always higher right now, usually by a significant amount compared to what we think fair value is. And one of our tenets is just don't overpay, regardless of the enthusiasm or the perceived opportunity. Don't overpay for something. There will be something that happens over the next several years that pulls these share prices back down to a level that if you want to buy into it later, you're going to get an opportunity. Just don't chase it now.
Earlier in June, we saw a divergence between the non-tech sectors of the S&P 500 going down, whereas tech is the only sector going up. A lot of that has largely reversed. For example, I'm just taking the financials index, for example, IYF is the iShares US Financials ETF. It was on a downwards trajectory ever since May, and that it's now more or less almost caught up with the S&P 500. Are you seeing the laggards starting to recuperate some of the losses over the last month? What's going on? What's driving this momentum? So the point I'm trying to make is that while it looked like in the first, I guess, half of the year, it was mostly AI and tech driven. A lot of that gain in the last 4 weeks or so has been non-tech. Are you seeing that as well?
Yeah, the number of companies that are starting to jump, especially in the last week or two. You had that big day where small caps outperformed large caps by the most in a single day since October 13th, 2008, was the last day where you had such a big gap in performance where small caps were the winner. So there has been a bit of it's called a mean regression trade most recently. It seems like that's excitement around this expectation that the Fed is going to start cutting rates in September. If you start cutting rates, maybe more cyclical industries that have been experiencing a growth slowdown, that could be a positive for them. Small caps that are carrying more debt on their balance sheets, if you get lower rates, they'll be able to refinance, hopefully, at a lower interest rate than what they would get if they had to refinance today. However, when we look at this, we don't think too much has changed. You're probably looking at one rate cut in September, and then we'll see what the Fed does after that. We actually think inflation could continue to trend a bit higher going into the end of the year. And when you've got growth slowing, which we think is the case for the remainder of the year, that's not a great environment for cyclical industries or small caps. So it seemed like a quick reversion, but we don't necessarily think that now's the time to really jump into small caps and cyclicals, thinking that there's going to be this catch-up trade. We think it's more likely that the tech industry, the semiconductors, the AI names are going to pull back more to the rest of the pack rather than everything else is going to catch up and go higher.
I want to come back to the semiconductors just a bit, but you mentioned inflation. So why is it that inflation may come back, Chance? So recall that the latest data point from June, actually June declined 0.1% from May, and annually it went down to 3% from 3.3%. So I'm curious to get your take on what's happening next.
Sure. Two factors I would point out. One is just the base effect. So when you're cycling off of a prior inflation reading, because a lot of this is looking at year over year numbers, when you're cycling off of a high inflation reading to an easier one, or if you're going from an easier one to a higher one, that makes a difference in terms of what the next inflation reading is going to be in the numbers. So we actually would expect that the inflation numbers look okay and look the way that the Fed wants them heading into that September meeting, which would give them the reason to cut once. But once you get past that point, we're cycling through easier comparisons, which means that you might see inflation readings go higher through the rest of the year from October, November, December. And another factor is that you had a benefit here where oil prices actually dipped a bit into this most recent CPI reading. The oil price is 14% higher than it was in June. So that's now back to being a bit of a headwind. So when you look at different comparisons like that, I think we actually expect inflation to stay a bit more sticky than anticipated while growth slows.
Do you think that a Fed cut would have anything to do with a reignition of inflation?
It's possible, but if they only are cutting once, I don't know how much of a difference that's really going to make. The thing that's actually interesting is because so many people have locked in a low mortgage rate, you've still got maybe 80% of homeowners with a pretty low mortgage rate in their homes in the United States. Raising interest rates from 0 to 5.25 did not seem to have the same impact as you might have expected on consumer spending. You're really only seeing the impacts now on credit card delinquency rates and auto loan delinquency rates, but maybe it hasn't had as strong of an impact. We would expect that actually it could be a similar issue when they do need to cut rates because growth has slowed. That can end up being a problem because it's not going to have the same impact going the other way. If it wasn't that much of a headwind when rates were going higher, it may not be as much of a tailwind as they hope when they do need to lower rates to try and boost the economy.
Your outlook on rate cuts is a little bit, I guess, more conservative than some of the Wall Street firms that have been making the news. Citigroup, for example, is predicting that any slash in interest rates would result in 200 points of cuts going into the next 8 meetings from now till 2025. This will lower the benchmark rate from 5.25 to 3.5. So this is because Citi is seeing fresh signs of a slowing economy and growing unemployment. A little bit more aggressive than your take. What's your response to that? Why would you possibly disagree with that analysis?
Well, I think it's sort of viewing it in terms of the progression of what would cause 8 rate cuts, as if that's what you're describing from that Citi report. That would be, in our estimation, that would be because growth is slowing and they have to cut rates. In that scenario, having to cut rates because growth is slowed, they're trying to avoid or minimize the effects of a recession. If something like that occurred, we're already positioned for something like that because we think that is a risk that we need to be mindful of. We think there's too much exuberance in financial asset prices, and therefore we have a lot of safety in our portfolios. I think the position that I think we're more conservative is people are expecting several rate cuts while everything just remains normal in the economy. And we would say we don't really see that happening. We are not going to be surprised if they cut once in September. But I think the assumption is that there's just going to be this straight trend line down back to 2% or 1.5% inflation here in the near future. And we're still not seeing that. As you mentioned, you've still got the CPI at 3%, even the core PCEs at 2.6, 2.7. You're still not getting down to that sustained level of 2% or lower like the Fed wants. It's hard to see them cutting several times in a row if they haven't been able to say that they've really declared victory on inflation to get back to where they want.
What is the outlook for the yield curve then for you if the Fed is going to cut rates this year?
We would expect it to stay inverted similar to how it looks now. And when it uninverts, it usually means that you really have a growth slowdown, a recession concern, and they have to cut rates. But in that case, it's negative for financial asset prices and time to really make sure that you are safely allocated. So, but in the meantime, we still have the majority of our assets, especially in our income strategies, invested in short-term treasuries. It's hard to beat a risk-free 5% annual return. We have added a little bit of exposure to the long treasury bond, looking out 20 or 30 years, but it's a very small percentage compared to how much we still have of the short-term treasury. But when you've got growth slowing, it's a decent time to add a little bit of exposure to things that are rate sensitive. So we've got a little bit in the long-term treasury bond. We've got a little bit in a investment grade corporate bond, and then we've added some exposure to utilities in our stock portfolios because that tends to perform well in this environment that we're seeing for the rest of the year.
So we can generally expect the short end of the curve to go down once the Fed starts cutting rates. I'm curious to what the 10-year is going to do. I asked you about this in the beginning of the interview if Trump would have anything to do with the 10-year, but factoring in politics and macro, everything together, what's your outlook?
We think that the 10 and the 30-year treasury yield can move somewhat lower, but it's not like we're expecting that it's going to go back down to some very low yield like we saw in 2020. It's more of just a somewhat of a decline that would be positive for long-term bondholders. Perhaps it goes down by up to 100 basis points, and you're able to benefit a little bit from that move as growth slows, and if that's factored into long-term bond yields. But it's still, in our mind, it's most important when you've got a 5% yield. And even though at some point they might cut the Fed funds rate down to 2 or 3% when they see a real growth scare, we don't see them doing that just yet. And we're going to keep locking in that 5% annual return when we don't see a great risk-adjusted opportunity elsewhere in the market.
Let's go back to the semiconductors. We kind of digress from that conversation. You have a chart here showing the free cash flow margins having fallen a little bit. How significant is this decline in their free cash flow? And ultimately, what does this mean for valuations?
Yeah, so in the long run, over the last 25 years, semiconductors have been a great place to invest because they grow faster than the overall economic growth rate. Their stocks trade at better free cash flow yields than the market. So you're buying at a discount, even though they're a great business. And they're a high free cash flow margin business. So higher quality, faster growth, and at a cheaper price. The thing that's different now is they're having to reinvest a lot in capital spending to try and keep up with the potential demand for AI. And it may prove to be true, but historically, when the semiconductor companies go through a big CapEx cycle like they seem to be doing now, that's a riskier time to invest in them. What makes it even more risky is that discount in terms of the free cash flow yield you were able to buy in at, that discount is gone. Everyone now sees the opportunity and is paying a premium to own these stocks at higher valuations. And there's really no precedent for that over the last 20 or 25 years. It may be warranted and they could still end up performing well, but when we look at each of these individual semiconductor companies that we would own at a cheaper price, we look at them, they all look overvalued to us at this stage. And it's worth remembering that the semiconductor cycle is volatile and it tends to fluctuate widely over a 2 to 5 year span. So we just went through a stretch a couple of years ago when they were cheaper. Now they're very expensive. It wouldn't surprise us if there's another opportunity in the next 2 to 3 years, but buying now, we would say is a very risky bet to make when it seems to be really different from where it's traded historically.
Okay, so Nvidia is up 167% year to date. The S&P 500 is up around 19%. Intel, another chip maker, is down nearly 30% year to date. That's the obvious laggard in this sector. When you see a peer or competitor to Nvidia down so much, just moving in the complete opposite direction, what's your initial reaction? Is that a buy opportunity for you?
No. So what I've learned through years of studying and family members, my father's been in the business for 50 years, and I was taught very early on, you're looking at an industry that's hot, that's really working, and there's one or two that are not working. That does not mean that they're going to automatically catch up and it's going to work. It usually means there's a company specific issue that you really need to dig into and believe that they can work their way out of it. It's not something as simple as, oh, well, it's a no-brainer that you could just buy that and it's going to catch up too. There's usually a good reason. For Intel's sake, they're going through a lot of issues trying to catch up to the level of technology that others already have, both in terms of manufacturing chips and in the design of chips. They're both behind Taiwan Semi and they're behind NVIDIA. And maybe they'll catch up someday. I think it'd be good for the competitive marketplace if they're able to. But right now, they have negative free cash flow while they're trying to figure this out. And it's been the case for several years. We actually owned Intel maybe a handful of years ago and got out once we saw that they were going to have to go through this much of an investment cycle. And if you have no free cash flow to work with, it's really hard to say that the stock's going to work. So it might turn around down the road, but as of now, we would say just because they've lagged does not mean it's going to catch up.
I remember speaking or talking about NVIDIA on my show ever since the beginning of 2023. Back then, it was hot. Back then, people were telling me, look, it was at $41, which was up from $10 in the beginning of 2023. It was up fourfold. People were saying, well, it's getting a little bit overstretched. By $100, people were telling me, look, it's time to get out. And now we're at 130, right? And so my question to you is, Chance, if I were to make the argument to you that, well, people have been calling this a overpriced or overvalued stock for more than a year, and it's just kept going up. Well, let's ignore valuations. I mean, clearly it's going up for some reason. Let's just get in now before we miss another 20, 30%. How would you respond to that argument?
The difficult part about that, like you said, like let's get another 20 or 30%. Whenever NVIDIA, if you look at its trading history, whenever NVIDIA goes through a down cycle in its share price, which usually coincides with their revenue growth decelerating, uh, the decline in the share price is always at least 50%. So that's your risk. And I don't know when it's going to peak and go through another 50% decline, but it's going to happen at some point. And that's not anything against the company. It's just the market they work in. There's these huge cycles up and down, and you have to know that going in. So I think part of the problem on the way up was you're trying to continually update your estimates of what they can perform, and they've just been outstanding at outperforming expectations. So, with the stock at $130 today, estimates we see that we agree are pretty realistic would say maybe it's worth about $100 today. But that means you probably need a 40% decline in the stock to feel like you're buying in at a discount. But that doesn't mean it has to happen tomorrow. When something's on this much of an uptrend, it can continue higher for as long as people want to keep buying. However, you already have started to see a deceleration in the growth rate. This quarter, they're going to report next. The growth rate is going to be less than half as much of what it was the previous 2 quarters. It's still a great growth rate, but when the rate of change starts to turn negative and go down, that tends to be a more difficult time for the stock to outperform. And historically, it means that the stock tends to peak within about 6 months of that peak growth rate, which occurred either in the January quarter or the April quarter. So it wouldn't surprise us if the peak's either already in or peaks sometime in the next several months, and then their performance of the stock gets a bit more choppy in the quarters to come.
You have another slide that says mega cap stocks likely to revert in 2-3 years, and you have a forward P multiple of the S&P 500, which is currently at 21 times, versus an equal weighted index, which is at 16 times. So, looking at this chart, Chance, could you make could one look at this and say, well, you're waiting for the PE to contract by a multiple of at least 4 to go back down to 16 before you feel comfortable getting back in?
We would view it this way. So with the S&P multiple at 21 times, the index in aggregate to us is overvalued. And if you look at previous history, when it's gotten this separated from the equal weight valuation, That happened around the dot-com bubble, and it also happened in 2021. You did end up seeing a correction in the market cap index back towards the equal weight valuation. We don't expect this time to be different. We would expect that sort of correction to happen sometime in the future. It doesn't have to happen right away, but at some point, those two will compress. The way we view it is we're not trying to chase those names that have driven the index up to 21 times. We're trying to see what other companies are out there that are trading at fair or even cheap valuations that we like the fundamentals of the business. We think it's a good time in the cycle to buy into them. And we're trying to build a portfolio that way because we think that's going to be the way that we get consistent performance. Even if the index pulls back, we think we can still do pretty well owning those types of companies. And this year, where we found that has been in sectors like energy, healthcare, utilities, and consumer staples, a little bit in consumer discretionary, but it's got to be a very high quality business that you think can manage through any choppiness in the economy.
How much would the mega caps have to pull back before you feel comfortable with their valuations?
Probably about 20%. One way to view this is you can look at a long-term history of the free cash flow yield of the market compared to the price. And 2014 to 2019 was a pretty steady valuation era. And on average, during that stretch, with a lot of these tech businesses carrying more of the index, but not to the weight that we're seeing today, you saw a 5% forward free cash flow yield for the S&P 500. We think that's a pretty fair valuation on average. Well, 5% free cash flow yield today would be an S&P 500 price of about 4,500. So you're probably looking at about a 20% decline to get back towards a more fair valuation. We can still try and find some things to buy in the meantime, but you'll find a lot more once you get a correction back towards that price.
Finally, you have a chart showing a golden decade of growth unlikely to repeat. What do you mean by that?
If you look through decades of history in the market, in every decade or even longer than that, there are stretches where there's one style of investing that is just dominant. And everyone by the end of that decade gets convinced that this is the way they've got to go. They want their whole portfolio to just be in this style because it's been a winner. And people project out and think that that winning will continue relative to the rest of the market. And if you look historically, that's usually not the case. It tends to shift, and it's a different type of style, different type of size of company, different sector that ends up carrying the next 10 years. So large cap growth has been this amazing performer for the last 10 years. We would just say that historically, we wouldn't expect another 10 years like that we just experienced. So it does not mean sell all of your tech businesses, sell all of your growth stocks. It just means start to balance out. I imagine anybody, their portfolios have gotten shifted more towards large cap growth because it's performed so well. But rebalancing when you see opportunities in other sectors, other styles, other sizes of companies is going to work out better for you over the next 10 years, in our opinion, rather than being so invested thinking that this large cap growth trend is going to continue forever.
So where is the opportunity for the next 10 years?
We would say two places. One, having some more exposure to commodity linked businesses. And there are some quality companies in the energy space, in the precious metals space, and other commodities that you can own. We think that's an area that everyone was very focused on that from 2002 to 2008, and that it's been completely forgotten in the last 16 years. But these things move in cycles, and we would expect having some more exposure to that area would be helpful. So we try and look for some opportunities there. The other thing to keep in mind is these past 10 years, especially from 2010 to 2020, you had zero interest rates, very low interest rates, which was the ideal environment for growth stocks. But if you're going to be dealing with a more normal interest rate environment where the 10-year treasury yield is probably somewhere between 3.5% and 5.5%, that's an environment that just having revenue growth for revenue growth's sake is not going to drive out performance. You need to have actual cash flow generation from the businesses you invest in and be able to buy them at reasonable prices rather than just saying, oh, this is going to grow 30% next year, buy it at whatever price is available. So we're trying to find things that are quality companies trading at reasonable valuations so that we think they can perform in a steady and outperforming manner, regardless of where that interest rate fluctuates. But that benefit of the 0% rates just by growth, that was a one-time experience that lasted for about a decade, and now you got to go back to what worked in previous cycles.
Just on the note of interest rates, so all throughout the last decade, when we had a zero interest rate environment, people were saying that the reason the stock markets were propelling to new all-time highs every single year, basically, was because of that zero interest rate environment. And then when we saw rates go up to 5%, we had a year of decline in stock markets, 2022, but then rates stayed high, and yet 2023 happened, and this year happened. I don't know why you would ascribe, or how would you what is the reason behind the past 2 years of rallies? Because it clearly wasn't low rates.
I think rather than interest rates, I think the difference is 2022, that decline you're talking about, it was the inflation rate. Inflation's spiking. So when inflation moves above 4%, you get a 5% inflation rate or higher, that tends to really put an anchor on equity valuations and really hurt the stock market. If you can keep inflation at around 3% or a little bit lower, that's a better environment for stock valuations and for stocks to perform. The thing that we're thinking about here is we would expect inflation and therefore interest rates to be significantly more volatile for the rest of the decade than what we experienced in the 2010s. And that's something that we're trying to make sure our portfolios can adapt quickly, that they're flexible, and that we try and stay balanced, because it's just going to be difficult to keep up with the changes in the economy, given that you've got not enough spending for key resources that might lead to inflation being higher and more volatile than what we had.
Okay. Great. Chance, appreciate your updates as usual. By the way, people can watch my last interview with Chance, link in the description down below if you want to revisit his past calls. Well, congratulations on your continued success. Where can we learn more about you and Oxbow Advisors?
Yeah, you can visit our website at oxbowadvisors.com or check out our YouTube page looking for us at Oxbow Advisors.
Okay, we'll put the links down in the description below. Thanks very much, Chance. Speak next time.
Thanks a lot, David.
Thank you for watching. Don't forget to like and subscribe.